Okay, so taxation and public spending, something that we'll often call fiscal policy, okay? How does the government raise money and how do they spend it? So, let's start off with tax over here. First of all, you need to know there's two different types of taxes. We've got an indirect tax, which is charged on goods and services. The most common you'll hear about is VAT at 17.5% or whatever it is in the country that you're studying, but essentially every product that is sold, 17.5% of the selling price will go towards the government there. Huge way to raise revenue for the government. The other type of tax is direct taxation. So this is charged on earnings. So you've got income tax and you've got corporation tax. So every employee that's earning money, a percentage of their income will go to the government, but the same as businesses, corporation tax is actually a tax on what profits they make. Okay, so they'll pay a percentage of their profits to the government as well. So that's indirect and direct tax. Two reasons why the government charges tax essentially is the first one is that they need to do government, public spending, which we're going to cover in a minute. In order to spend money on public services, they need to raise money. So it's literally just a way of raising revenue in order to do government spending. And then the second one is about controlling consumption of certain goods. So a lot of goods have negative externalities. They have external costs associated with them. Or consumers, we don't really understand that products are worse for us. So things like alcohol and tobacco, we consume too much of them. They are unhealthy. Things like petrol that causes carbon emissions and climate change. All of these things, if the government did not tax them heavily, we'd consume too much of them and a lot of markets wouldn't function properly. So we've got two reasons: raise government revenue or to reduce consumption of a demerit good. Okay, so these goods that have external costs essentially. Okay, so what are the impacts on businesses then of taxes? Well, high taxes will reduce profits that can be reinvested to grow the business. If the business is giving a proportion of their profits to the government, they're not going to be able to reinvest, research and development and innovate. So we're going to see less innovative markets with this high taxation. Also less incentive for entrepreneurs to start businesses. Okay, if you're being heavily taxed, there's less incentive, there's less point in having the business in that country. And we'll see a lot of businesses move international locations to try and actually locate their business where there is lower corporation tax. So actually they can reward their shareholders with more of the profits rather than distributing the profit to the government. Okay. Okay. So once the taxation has occurred, what does the government do with it? Public spending. Okay. So tax is used to pay for public services such as healthcare, police, defence, care for the elderly, and essentially they're intervening in those markets because they have to try and correct the market failures. Okay. So tax is used for public spending. Benefits to the private sector of public spending. Okay, so we've got to think to ourselves, it's unusual for students to think about this, but how the government spending money, how will this actually benefit businesses? Well, essentially, they will be spending money on roads and communication networks, and we call that infrastructure, how developed somewhere is. Now, if there's better roads, that will lower the cost of production of businesses being able to distribute their products easily. If there's better communication networks, they'll be able to maybe access international markets using the internet. So infrastructure is how developed the country is, and it's a real advantage to businesses if there's superior infrastructure. So if there's a lot of government spending, they'll be spending on infrastructure, which is good for businesses. The other thing is actually financing them, so providing subsidies and grants. So the government could give subsidies to businesses that they want to increase supply to. So something like milk in the EU is subsidised heavily to try and increase the supply of milk because of all the benefits that we get from milk. There might also be things like new green technologies, things that we think are going to help the environment, in which case we might want to give subsidies and grants to those types of businesses as well. So if we have more tax, we will actually have more money to spend subsidising businesses that we want to increase supply for. And then thirdly, if we're spending lots of money on public services such as healthcare, police, defence, well actually, those public sector businesses will demand a lot of products from our private sector businesses. So increased demand for private sector products. For example, the National Health Service buying privately made medicines, or police buying uniforms and cars and things like that. So if there is spending on public services, they will actually increase demand on the private sector businesses. Okay, but evaluating public spending, we've got all these benefits to private sector, which is great. However, If there's more government spending, we have to realise there will be higher taxation. Okay, the government cannot just keep printing money and then spend it with that. That's not going to be a sensible economic policy. So in which case there has to be a balance. There's an opportunity cost. Wherever they decide to spend money, there's an opportunity cost associated. So to evaluate it, more government spending will require higher taxation, which, as we can see, is also not ideal to businesses. Okay, so that's the fiscal policy stuff, taxation and public spending.